Welcome to Top Stock Picks. This is April 4th, 2017, and I am your host, Jay Taylor, and I'm really glad to have with me once again Michael Oliver. As I've explained, this new podcast is an adjunct to my weekly radio show, Turning Hard Times into Good Times, aired every Tuesday at 3 o'clock Eastern Time on the Voice America Business Channel. 1 hour per week of airtime at Voice America simply is not sufficient to cover all the material needed to be discussed now that the gold and gold shares are in a bull market once again, and it certainly is a lot more enjoyable, a lot more fun, but it takes a lot of time to talk about all the companies that we need to talk with. Well, one of my most prized guests and the most frequent guest that I've had on Turning Hard Times into Good Times is Michael Oliver. But more recently, as I've noted, the time has been compressed with Michael because of these other constraints. And so what I'm doing with Michael, as well as other people, is starting the Top Stock Picks podcast, which will be aired on Tuesday as well. So people that listen to my regular radio show will be directed to go to Top Stock Picks at jtaylormedia.com. Well, people have started to complain a little bit that they're not hearing enough of Michael. So really glad to have Michael with us. And, the best way to get the most out of Michael Oliver, of course, is to subscribe to his letter and go to olivermsa.com, olivermsa.com to sign up for Michael's wonderful letter. I get it. And it's, he talks to us here about gold and gold mining shares to a certain extent, about the broad market, the stock market, debt markets, and so forth, commodities. But Michael really hones in on individual markets like no one else I know. And the kind of work that he does has been most helpful to me. Not only does he give me a sense of which direction, sort of the big direction of various markets, but also helps me to see the interrelationship between various markets. And that makes his work really very, very interesting. Well, I really want to thank you, Michael, for joining me again today.
I'm glad to be here, Jim.
Michael, you've been talking and focusing more recently on the dollar. And I remember going back a year or so ago, you started talking about major plate tectonics, and currencies was one of those. You felt that the dollar was probably nearing an end of its bull market, not necessarily going down immediately, but that probably the dollar has, most of its run is over with. Talk to us about the dollar. Where do you see it now?
Well, let's talk about the dollar index, which, of course, is trade weighted, and
Sure.
The euro is about 57% of its weighting, and the yen, I think, is about 15%. So it's primarily weighted by the euro. But if you look at those two currencies, the biggest money units in the world right now, let's say, they've done nothing for about 2 years. The dollar trading right now is just above 100. It was just above 100 in 2015, just above 100 in 2016. So we're going nowhere. Mm-hmm. And yet there's still the sentiment that it's a bull, which by definition I think you have to say yes, it still is. But it has the technical attributes in our work of a likely topping situation. The recent surge up to 103 and change early this year, marginal new high for the bull market by a few percentage points out above where it was 2 years ago, didn't hold. And momentum laughed at it. Momentum was not making a new high, even though price did. And that's another attribute that indicates tiring of a trend. And there's a structure underneath it. In other words, if you look at a momentum chart of the dollar going back to even to 2004 on an annual momentum chart, there's a structured uptrend line that's been hit, and hit. Mm-hmm. And we're clustering on it right now. And before this year began, we said 99 was a key level. If we ever saw a monthly close at or below that level, we were bearish. Mm-hmm. Well, in February, they sold off from the 103 high and dropped down to 99.23, and then hot-footed it up out of there and got back to 102. Mm-hmm. Slightly up on the year. We closed last year at 102 and change. Then it turned around last month and drove down through the February low, dropping to 98.85, just barely below 99. Mm-hmm. In fact, I checked the hourlies, spent like 1 or 2 hours below 99. Uh-huh. And again, hot-footed it back over 100, which is where it is now.
Yeah.
So it knows, it's like, an animal almost, it knows that's a level it doesn't want to close a month low. It's a key level. Not on price. That's not at all important when you look at a price chart, but on annual momentum. So we still are leaning toward the view that it's topping, but we know where we think the breakage point can be defined, and I want a monthly close at or below 99. Mm-hmm. And if I see that, then I think finally those two major money units will wake up and create some dynamism. Mm-hmm. But there's no dynamism whatsoever in the euro and the dollar for the last 2 years. They're just a narrow, wandering set of charts, sideways. So now, when you think about it, that's a huge asset class.
Yes.
And if it's been dormant, that means it hasn't created any wave effect in the other markets.
Right.
But if they wake up and you get volatility out of the foreign exchange, the major units, that will translate into volatility transferred to commodities, debt markets, and so forth.
Right,
So
exactly.
I think,
Exactly. And one of your other major plate tectonics, one of your major plates that you figured were going to be turning bullish, I guess more or less when the dollar turned bearish, was the commodity sector in general. But within the commodity sector, of course, you can't just take them all as the same class, as the same asset
right.
class entirely. Talk to us about what you see in the commodity markets. I mean, irrespective of the dollar, do you see commodities generally in a bull market here?
Well, yes. We measure via the Bloomberg Commodity Index, which is a good proxy for a balanced view of the commodity asset category. It's not heavily weighted to energy or anything of the sort. Last year was a good year for commodities. The Bloomberg went up about 2% more than did the S&P. Nobody cheered that, but of course they cheered the S&P. But the Bloomberg was actually up a couple percent more than that on the year 2016, and it did it with only half of its baggage. Because grains were laying on their back on the pavement, meats were going down, cocoa was going down. But then if you look at sugar, copper, gold, silver, oil especially, you had strong up moves. So the Bloomberg outbeat the S&P last year by a couple percent with only half of the markets positive within it, and some of them are actually negative, the meats especially. So it did a lot with very little, and it certainly didn't have any foreign exchange assistance via a weak dollar.
Yeah.
So again, if the dollar did get weak, you could get a dynamo out of the commodity complex, because it's our view that the ones that were dormant last year or going down have now bottomed and are ready to turn up. The interesting twist, though, is to get a unified chorus in the commodities. We've got to watch. Right now, there's a correction underway that we anticipated in crude oil, which we think needs to go down to 40. Copper, which was up to $2.80. It's now just below 260, and we think it could drop into the 240s, so more correction there. Sugar, which I think was up to 21, it's now under 17. We think there's a bit more downside there. If you can take those markets that were the strong leaders last year, let them have their correction, which they need to have, turn everybody negative on them again, et cetera, but get them down to levels where they can then turn again. If that turn in those three markets, that's copper, oil, and sugar, if they can find a low in a correction, which we think will be a safe low, higher than their bear market lows, turn up again and do it in unison with grains, and then we get a dollar shift as well, we'll have a super strong commodity market because it will be unified. So right now, you're right. You can't treat commodities as one lump sum as a group yet, but I think there's potential that it could become one in the latter half of this year.
Where does gold fit in, Michael? Where does gold fit
in? It's one of the first guys to turn up. It turned up in February last year. We had a huge correction late last year, but it stopped within $4 of a level that we did not want to see. We didn't see it, therefore it didn't change our view on the long-term view of gold. And it's now back up to 1260 area. And we think if you can close out a week up here in the 1250s, you're probably going to tack on your next up leg. And last year's high was 1370 plus in gold. But if you see 1309 this year, which is well below last year's price high, we're quite excited that we're going to plow on through. That's another sign that gold's going to tack on a whole new leg above last year's high. So we're $50-some short of that at today's levels. But you add another $50, and remember, we just rallied about 140.
Right.
It's a December low. Okay, so we're just saying add another 50, and you're really going to add some.
Yeah.
So gold is in stride. Silver's doing a little better recently than gold. It's looking good. So what's confusing here for most people is the weak oil market. And I think if you see that drop, it's going to turn sentiment negative on commodities in general, which I think is inappropriate, technically unjustified. Oil, in fact, is a buy down there, not a sell, but it needs to get down to the low 40s, we think. And anyhow.
Well, very interesting, very interesting. With regard to the stock market, it doesn't want to seem to go down, Michael. It seems as though as soon as we get to sort of key levels, all of a sudden computer trading kicks in, and the logos are in there, and all of a sudden we're not making anything substantial in new highs, but we're just basically flopping around with stocks too. And then you're seeing a topping pattern there.
Well, I think so. The intermediate and the short-term stuff turned negative back 3 or 4 weeks ago, and that was when we were up in the 2370s, 2360s. We dropped to 2320 something, 2322, I think it was, at last week's low, and then turned hard from there. Now, as it happens, that level, that price level, which if you look at a price chart doesn't particularly mean anything. But on our longer-term momentum charts, once we got into the new quarter, it does mean something. If you go back, I'll just leave it at that. If you go back to last week's, what they think was a pivotal low, if you ever take that out, it's not just a minor price violation. It's very significant. It's a lot of long-term momentum indicators. There's some other numbers layered below the market, and there's 3 layers we've defined that are trigger 1, trigger 2, and trigger 3, based on long-term momentum. But the lowest one is about 4% below last week's low. So there's not a lot of room here. If you're a bull wishing for a buyer's situation, a nice correction, don't. Because it won't be a correction. You cannot afford a 3 to 5% pullback in the market from these levels.
Wow, interesting. Dangerous territory for the bulls, no doubt. Well, just one more major market, of course, is the T-bond rates, the T-bond market. Regarding the debt markets, I interviewed Danielle DiMartino Booth for my radio show. She was Richard Fisher's assistant, actually advisor at the Dallas Fed when Fisher was there for some 9 years. She just finished writing a book titled "Fed Up: An Insider's Take on Why the Fed is Bad for America." And one of the topics I talked to her about was, were the interest rates, and she sort of has a sense that maybe the Fed, which is somewhat hostile towards Trump, may be raising rates just simply to do him harm. And she suggested that, however, she doesn't think that rates can rise a whole lot because her idea is that as soon as rates start to rise, people are going to come out of the equity markets. Pension funds especially going to come out of the more risky assets and start to take on some yield as it starts to be supplied. That's sort of a fundamental viewpoint, a political and fundamental viewpoint. But what's your latest idea about the T-bond market now, Michael?
Well, we measure via the T-bond futures, which have been around for several decades, since the 1980s, and they're 30-year debt instruments. There's also a 10-year note and so forth, but we watch the T-bonds. The high of T-bonds was last summer at 176 price level. Yield then was about 2.11 was the low in yield. Okay, 30-year again.
Yeah.
When the T-bonds dropped to 166 last October, we turned major bearish because at that point annual momentum uptrends were broken on momentum charts, not price charts, and a 200-week oscillator, which is like a 4-year average. It broke trends. So we had enough breakage of long-term indicators to say sell. That was at 166. It dropped to 148 and change in December. And we had expected at that point it could have a very sharp counter-trend rally to at least 156. Instead, the rally got stunted. It couldn't get to 154. And it backed off and made a new low recently last month, just above 147, meaning it took out the December low by it was actually less than 1 point. Now it's back up to 151, 152, and we think there's still a chance for a short covering counter-trend rally, the kind of thing that turns heads. But it's a failing rally ultimately. But what we had in mind was when that rally gets underway, we suspected that you would be seeing weakness in the stock market. So that some of the motivation of the buying of T-bonds would be movement out of stocks.
Right.
Well, the stocks are off their high. They're not exactly being destroyed, that's for sure, but they're 50 points off the recent high. And so it's possible if we're getting this T-bond short covering rally, it could be correlated to further weakness in the stock market. But ultimately, the T-bonds look like they're going lower, meaning yields are going up. And if we ever see T-bonds close out a month, the nearby front month contract, at 142 or lower this year, anytime this year, which again is only about 5 points below the recent low, so it's not that far.
Yeah.
We think T-bonds will drop into the 120s. That would take yield from that low last year, 2.11, up to 4.25.
Whoa.
I don't know what other effects that might have, but I suspect it'll have some effects. So while we think there's a rally right now that could get unplugged here and get a rally up into the 150s, we think that rally's likely to fail because it's counter to the major trend, and we think ultimately you could get this thing you could double yields easily from last year's lows.
Oh, really interesting stuff. And it's not hard to see then, Danielle DiMartino Booth's idea that if rates start to rise on that kind of scale, that there would be money coming out of more risky assets by the pension funds and others to try to grab some yield. The pension funds are having a heck of a time right now keeping up with the demands on their aging members. So it's very interesting times, Michael. Anything else you'd like to add today?
No, we're going to be looking at internally, and we do this with various sectors frequently, is we don't just look at the net trend of a given sector, but we update the gold mining sector frequently, and we're going to look inside the GDX, for example, its major holdings, which include gold and silver miners, and look at relative performance strictly. Don't care about the up or down in price. We care about which stocks within the GDX are outperforming, which are underperforming. And just like any sector, it's always the case that there are stocks that are better to be in and others to avoid within a given sector based on relative performance. And we measure that via spreads and via analysis, momentum analysis of the spreads. So we apply our method that way. And so it'll be an internal look, like an X-ray of what's inside the GDX.
Oh,
better place to be.
Very interesting. We certainly would like to hear what you come up with when you finish that study. When do you think you might have it done?
Oh, I think this week we're going to get it done. And, if anybody'd like a sample copy, they go to our site and request that, and it'll be issued probably later this week.
Right, that's OliverMSA.com, folks, OliverMSA.com. Thank you, Michael, for being with us
Thank you, Jay.
and for sharing your thoughts and ideas. It's always a pleasure talking with you.